Hi, Andrew from The Investor's Way here, and welcome to day 25 of my 30-day video challenge, where I've been answering your questions and just giving a bit of information in relation to managing your money and investing, and hoping that through your likes and shares and comments that we can spread this message to as many people as possible, so that they can all begin their journey or continue their journey to financial freedom. And today I want to talk about a topic that could probably take many hours, but I'm going to try and distill it down to some key points in this short little video, and that's the concept of diversification. And it's something that people talk a lot about, and you'll hear it as a key requirement of a secure and reasonably well managed in terms of risk portfolio, and so it's something that I think it's important that we understand, because there are some rabbit holes that you can go down with diversification that don't necessarily result in a better portfolio or a better managed portfolio in terms of risk. So clearly the concept of diversification is to manage your risk, to spread your investments across a number of places or outlets, so that you're not caught out if something goes wrong in one or the other that you may be in. So it's just simply broken down as meaning don't put all your eggs in one basket. But diversification can be managed a number of ways, but let's say its two main aspects are both time or time frame and asset class. So when it comes to time frame, you can have short, medium, long-term investments, and that is one form of diversification. And short term, if you're a trader, which I don't recommend being if you're just starting out, it's certainly for the more advanced investors. But if you're a trader, short term could be 1 minute, whereas for people just starting out, short term might be holding for a few months or even a year. So diversification can be managed across time frames, and I suggest you break them down into short, medium and long term, and define them as to what that means for you and your investments. And then you have some diversification in terms of risk management on a time frame basis. Then you can look at the asset classes. So we've already talked about in these videos property, stocks and cash-based investments. So there's diversification at a high level in terms of asset class. But then within each of those you can have diversification as well. So in your cash-based investments, you could be looking at term deposits, bonds or ETFs, and that's an element of diversification for cash. Then if you were to move into stocks, you can have diversification in a number of ways, and that could be as simple as direct investing into stocks or ETF investing into stocks. Then you've got index-based investing or ETF investing. Then you could even look at by country, by market segment, and each of those represent a different form of diversification. So that can get a little bit complex, but I'll come back to that. And then in property, you can have residential investment, commercial investment, or even ETFs. So, and there's a number of other ways that you can diversify in property that I won't go into today. But as you can see, diversification can get down to some really deep levels of granularity. So the important thing is to understand what's going to work for you and what's easiest for you. And I would suggest if you're just starting out, then you can look at the higher level ways to diversify, such as asset class, and then look at your ETFs, maybe even look at your regions and your countries as to where you want to invest. But if you're getting down to more granularity and more detail, that generally means you've got to be doing more research. So when a lot of people tell me they don't have a lot of time for investing, then that form of diversification may not work for you, and so you're better off to stay at the higher level. But as you can see, there are many ways to diversify your investment money to ensure that, as I said at the beginning, you don't put all your eggs in one basket. And that is the key to risk management, is to make sure that you have spread your risk across a number of investments, so that if one goes bad, it doesn't ruin everything that you've been trying to achieve. So diversification, as I said, it's a massive topic, and one that requires lots and lots of detailed training for the very granular level. But at the higher level, let's just have a look at Timeframe, asset class, and then maybe one layer below that. From Timeframe, it's short, medium and long term, and from asset class, property, stocks and cash-based investments. That's a really good start on diversification, and if you want to go further, then there's more that can be done, and I'm quite happy to share that if you leave a comment, and we can have a conversation about ways to diversify. So as I said at the start, don't forget to share and like the videos, and if you've got a question you want answered, leave a comment, and let me know in the comments box as well if this information is helpful. And I hope you have a great day. I'm Andrew from The Investor's Way, and I'm dedicated to your wealth.